Just brushed $91. And then the rules changed. Not next week, not later. Right after the spike, CME stepped in and tightened the screws. Higher margins, stricter requirements, more friction to hold the exact same position. And that single move instantly flipped the mood from "this is unstoppable" to "wait, who just grabbed the steering wheel?" So today, we're breaking down exactly what happened, why that $91 print matters, what those rule changes really do to price, and what the next phase could look like for silver, gold, and miners. Stick with me, because the shakeout everyone's about to panic over could be the setup, not the finale. Now, quick note before we go deeper, I'm running a campaign to eliminate copycats and recycled channels that lift original work and repost it like it's theirs. If you value real analysis and real effort, I need your help. Subscribe and comment. OG John AG under this video. That one comment is a signal to the algorithm and a signal to me that you want the original voice to win. And because I want the real audience close, I also created a WhatsApp channel. Daily updates, quick market notes, and I'll drop new video links there first so you never miss a move. The link is in the description. Join it and you'll stay ahead of the noise. All right, back to the moment everyone's talking about. Silver ran hard into $91, and it wasn't a gentle climb. It was the kind of push that makes traders sit up, makes headlines scramble, and makes risk managers start sweating. Then the exchange changed the playing field. And even if you've never traded a contract in your life, you need to understand what that means because it affects the whole market, including spot pricing, sentiment, and the way big money behaves. Here's the simple version. When margins rise, the trade gets heavier. You need more cash to hold the same exposure. That forces some people to reduce positions, and it scares others from entering. Not because the story changed, but because the cost of participation went up overnight. And that's why these moments create the same pattern again and again. Surge, rule, change, wobble, panic, then a decision point. The only question is whether that decision point becomes a real reversal or a mid-move fake out that launches the next leg. If you've watched markets for long enough, you already know the answer is rarely simple. But the clue is always in the reaction. Not the news, not the opinions, the reaction. Because strong markets absorb pressure and keep walking forward. Weak markets crumble the first time the wind changes. So let's talk about what people are missing. Most people are staring at the dollar price and asking, am I too late? And yes, buying at $20 would have been nicer. Buying at $30 would have been nicer. Nobody argues that. But late isn't just about price. Late is about positioning and narrative. Late is when everyone believes the same thing. When the media applauds the move, when your barber is giving you targets, and when you feel safe buying because it already went up, that's not this. Right now, the tone is still suspicious. The coverage is still weird. The financial networks still treat gold and silver like they're guilty until proven innocent. Stocks grind higher by inches and get praised like heroes. Metals move and suddenly it's excessive and dangerous and overdone. Translation? Stay out. And honestly, I prefer it that way. The explosive phase comes when the crowd finally sprints in. If they're still trying to keep people on the sidelines, we're not at the end of the move. We're in the messy middle where the biggest gains are usually born. Now, let's address silver specifically because silver doesn't behave like gold. Gold is a tank, it's steady. It's powerful, but it's not built for the same percentage violence. Silver is the metal that can sleep for months, then move like it's possessed for weeks. And that's because silver is both monetary and industrial. It sits at the crossroads of fear and necessity. When money wants protection and industry needs supply, silver can gap. That dual identity is why silver's breakouts feel unfair. They don't politely rise, they explode, then they try to throw you off the ride. Which brings us back to the CME change. A lot of people heard rule change and immediately translated it into they stopped it. But that's not how this works. A rule change doesn't cancel a trend. It adds friction. It can force a pullback. It can create a shakeout. It can slow the move and flush weak hands, but it doesn't magically erase why the move started in the first place. Think about it like this. If nothing was happening, nobody would touch the rules. They change rules when pressure shows up. They change rules when volatility threatens stability. They change rules when exposure becomes uncomfortable. So, in a strange way, the fact that they reacted is a form of confirmation. The move mattered enough to trigger a response. Now, let's talk about the shakeout, because this is where most people lose money. When markets enter a breakout phase, they rarely go straight up. They do a thing I call the jiggle, a violent mid-move reversal that looks like the top. It convinces late buyers they were wrong. It convinces early buyers to take profit. It convinces spectators that the story is finished. Then, when the emotional selling is done, the trend resumes and rips higher. That's the trap. And the CME margin change is the perfect ingredient to create that trap. It gives the market a reason to wobble. It gives commentators a story to scream about. It gives fear a headline. And fear is the best tool to separate you from a winning position. So, what should you watch instead of the headlines? Watch whether dips get bought aggressively. Watch whether silver holds above key breakout zones, even if it dips. Watch whether gold stays firm while stocks get tired. Watch whether miners start outperforming the broad market on a relative basis. Those relationships tell you where the flow is going. Because the real story here isn't only silver, it's rotation. We're watching capital slowly shift away from overcrowded trades and toward hard assets. Not everyone is doing it yet, not the public. But the early flow is visible if you stop staring at the surface. The S&P can print new highs while feeling exhausted. It can crawl forward and still be in distribution. Meanwhile, gold can surge and still be ignored. That combination is often the early stage of a regime change. And when regimes change, ratios matter. One of the cleanest ways to understand the silver move is to think about silver relative to gold. Over history, there have been moments where silver reached a much larger percentage of gold's price than it does during sleepy periods. Even after a big run, silver can still be cheap relative to gold if that relationship hasn't normalized. And that's why the upside can be dramatic. Not because silver needs a fairy tale, because the relationship can stretch. Now, bring miners into the picture. Miners are the leverage play that most people either love at the top or hate at the bottom. And the reason they get burned is because they trade miners like emotions instead of a structure. Here's structure. The mining sector is tiny compared to the ocean of money in broad equities. When even a small percentage of capital rotates out of bloated index exposure and into miners, miners can move like rockets. That's not magic. That's math. The other structural point is valuation. For years, miners have been priced like a dead industry. Some of that was deserved: cost inflation, dilution, mismanagement. But long neglect creates long opportunity when the tide turns. So if you're still haunted by memories of miners collapsing during past equity chaos, understand this: the setup depends on relative strength. If miners are breaking higher relative to the broad market, the condition is different. It suggests money is choosing them, not abandoning them. And that's the kind of signal that can precede a powerful multi-month run, especially when metals themselves are strong. Now, let's step back and ask the most important question. Why did silver hit $91 in the first place? Because markets don't move like that for no reason. Even if you ignore every single data point, you can't ignore psychology. People are tired of fake stability. People are watching currency creation. People are watching debt. People are watching political risk. People are watching official inflation not match their real life. And in that environment, hard assets stop being a hobby and start being a lifeboat. That's why the narrative around metals is always strange. Metals don't just threaten portfolios, they threaten confidence. A rising metal price is a scoreboard that says the currency is losing purchasing power. So, the incentives around the conversation are not neutral, which is why you will keep hearing the same phrases. Overbought, excessive, too late, dangerous, bubble. The goal is to make you doubt the move before it matures. Now here's the cliffhanger. What if $91 wasn't the peak? What if $91 was the test? Markets often spike to prove a level is possible, then slam down to scare everyone away, then rebuild from a higher base, and launch again. That pattern is older than the internet. And the rule change could be the excuse for the slam. So if you're waiting for confirmation, understand what confirmation usually looks like. It looks like you buying at a worse price when the public finally believes. That's why I say this. Missing the bottom doesn't mean missing the move. The bigger money is made in the sustained trend, not the first candle. Now, I want to make this practical with a simple roadmap. First, expect volatility. If you can't handle volatility, you shouldn't touch silver, even indirectly. Second, separate your time frames. Short-term noise is designed to shake you. Longer-term structure is what builds wealth. Third, watch behavior after the rule change. If the market shrugs it off, that's strength. If it dips and gets bought, that's strength. If it collapses and can't recover, that's information too. Fourth, watch the miners relative to the S&P. If miners continue to gain relative ground, the rotation story is alive. Now, quick creative interruption, because I know many of you want real-life motivation, not just charts. If you want silver-related success stories, there's a link in the description to another channel where people share how they built wealth using metal strategies, discipline, and smart risk management. Subscribe there too and watch a few stories. Some of them are wild. All right, back in. Let's also talk about why the CME move feels personal to people. Because it highlights a truth. Markets are not a pure democracy. They're a system with gates. And when the gates tighten, smaller players feel it first. That creates anger, distrust, and ironically, more interest in owning the thing outside the gate. That's why these rule changes can backfire narratively. The more people believe the game is being managed, the more they want exposure to assets they can hold, not just paper claims. Now, let me ask you two questions, and I want real answers in the comments. Do you believe the CME rule changes are simply responsible risk control, or do you think they're a way to protect certain positions from a runaway market? And if silver does a mid-move jiggle from here, will you treat it as an opportunity, or will you assume the run is finished? Drop your view below. The best comments influence what I cover next. And while we're here, if you're one of the successful people watching, maybe you've built a solid portfolio, maybe you've stacked consistently, maybe you've turned discipline into real results, share a quick success story in the comments. It helps other viewers realize this isn't theory. Real people are winning quietly. Now, I want to close the loop on the too late fear one more time. People think late means price is higher, but price is just one dimension. What matters is whether the move is early in the adoption curve. If the public is still skeptical, if the media is still hostile, if the system is still tightening rules, and if the asset is still fighting for respect, that's not the late stage. That's the stage where the next leg often forms. And here's the final retention punch. The most dangerous moment in any breakout is right after a headline event, because that's when your brain wants certainty. Your brain wants a guarantee. But markets don't pay you for certainty. They pay you for managing uncertainty better than the crowd. So don't let one rule change hypnotize you into thinking the entire story is over. Let the market prove it. If silver stabilizes and keeps pushing, the rule change becomes a footnote. If silver shakes out and then rips higher, the rule change becomes the reason the crowd got left behind. Either way, you now understand the mechanism, and that's power. So here's what I need from you, short and simple. Subscribe, join the WhatsApp channel in the description for daily updates, and if you support original content, comment OG John AJ, so we can push back against copycats together, because the silver story didn't end at 91. That was the moment the system reacted. The next moment is how the market responds to that reaction, and that's where the real move usually reveals itself. Here's the behind-the-scenes detail. When the exchange raises margin, they're saying, this market is moving too fast. Your broker enforces the higher requirement, and if you don't have enough cash, you don't get a long debate. You get a margin call, or you get trimmed. That's why price can dip right after the announcement. Forced selling isn't opinion-based selling, it's mechanical. So never confuse a sudden drop with a sudden change in the bigger story. Sometimes nothing changed, except leverage got squeezed. Now, here's what matters. If silver can absorb that squeeze and still hold key levels, that means the buyers underneath aren't just gamblers. They're committed. They're not relying on max leverage to stay in. And when weak hands get forced out, the next push can be cleaner because the market isn't packed with people who panic at the first ugly candle. There's another twist. Rule changes like this can push people away from paper exposure and toward physical ownership or longer-term positioning because nobody likes a game where the cost of entry changes overnight. That shift doesn't always show up instantly, but when it does, it tightens the real-world market over time. So watch sentiment, how people talk, what they fear, and what they're quietly buying while claiming they're waiting. That's where next moves leave clues before the chart does, because the next big surprise might not be a new high. It might be a gap. It might be a weekend headline. It might be a sudden shortage narrative that appears after everyone relaxed. And if that happens, the people who hesitated because they wanted one more perfect dip will be the ones chasing. So I'll say it again. The story isn't whether you bought the bottom. It's whether you recognize the phase you're in and whether you can stay calm when the chart tries to bully you. Stay sharp. Stay patient. Watch the reaction, because the reaction is where the truth hides.